Let's talk about stock options. We've got a topic here. Oh my gosh. If you're watching me live every day, you know how this is becoming more and more of a topic every day in the channel. What are stock options? Let's just get back to the basics. What is a stock option? It is a an instrument that was created by the brokerage business back in the 70s and then perfected in the late 70s and the 80s. Basically similar to what had been going on in Chicago for decades already, which is the futures contracts on pork bellies, corn, wheat, soybeans. Farmers back in the day, especially in the Depression era, but prior to that, they wanted to know, if I plant crops this spring, what price am I going to get for my wheat or my corn or whatever I'm planting? Or if I'm raising hogs, pork bellies, how much money am I going to get for these hogs if I raise them for whatever number of months it'll take to get them to a level where I can get them to the slaughterhouse? I don't want to be raising crops and then having to deliver to the grain elevator and be told then how much I'm getting for my crop, because I'm gambling completely blind what's going on. Now, the speculators in Chicago, and mainly with the grain firms in Chicago, they wanted to know, well, how much do I have to pay you for the grain, so that when I buy your wheat from you at the end of the growing season this year, how much is it going to cost me, so I know how much I have to charge for flour after I mill it to all of the bakeries out there. I mean, everybody needed to know some certainty of pricing. And that is how futures began. And farmers eventually would pre-sell their crop at a set price as a futures. And they knew that I will be paid so much a bushel if I can deliver this many bushels to the grain elevator. That gave the farmer an idea that I have to keep my costs below the price of this contract, so I have a profit. Every penny below the cost of every penny below what I'm going to get for this wheat is profit. Every penny I lose if I spend too much money to make this crop, I lose money. If I have to deliver 10,000 bushels and I only deliver 8, I'm short 2,000 bushels. I got to buy contracts back because I can't deliver 10. If I produce 12,000 barrels or bushels of wheat and I have to deliver 10, I have 2,000 bushels left over that I can either sell on the spot market, or I can buy options or futures on those and deliver them later. On stock options, it's a little different. The stockbrokers out there went, how can we make extra money, and how can we help people gamble in the stock market, and how can we find a way for those who hold shares, who don't want to necessarily sell their shares, how can we help them make additional income while they're holding their stock? And how can we help investors who don't have the money to buy 100 shares at a time, which is what you used to have to do. You used to have to buy 100 shares at a time, called a block trade, to be able to buy stock at a decent price. How can we help investors make money on a stock going up or a stock going down without shorting or going long 100 shares at a time for the full price? Okay, so that is what how this all kind of came to be. So in the 70s and the 80s, the geniuses in Wall Street and Chicago put their heads together and thought, okay, well, in the New York Exchange and the NASDAQ and the American Exchange, we're buying and selling stock all the time. In Chicago, they're really good at doing the futures. Why don't we have options trading in Chicago? And we'll have stock trading in New York. And the Chicago guys will watch what the stock does in New York. And as the shares fluctuate in price, the contracts will fluctuate in price in Chicago. And brokers can then choose with their clients what you want to invest in. Do you want to just buy IBM stock in New York, or do you want to buy IBM call or put contracts in Chicago, gambling on the movement of the stock? So a basic option, a call option, just a basic call option, it represents 100 shares of stock. 100 shares is equal to one call contract. If you're going to go long, if you think the stock is going to go up in price, you're going to buy a call contract. If you think the stock is going to go down in price, you're going to buy one put contract. That is the opposite of a call contract. Now, This represents, again, 100 shares of the stock in question if you buy one contract at a time. You want to you want to gamble on 1,000 shares, you'll buy 10 contracts. You want to gamble on 500 shares, you'll buy 5 contracts. You want to gamble on 10,000 shares, you'll buy more contracts. But they will trade in one call contract increments only. They will have a limited amount of time. They'll have a set price, and away we go. In Chicago, instead of having just the stock quote, so let's say IBM, the IBM quote might be like this past Friday, we were sitting at about $140 a share, something like that. $140 each. That would be the stock. But on the contracts, we have contracts that not only are at $140 in price, they're priced at now every dollar down and up. So there are call options and put options out on the Chicago market that are anywhere from, say, $100 each for a contract up to perhaps as high as, say, $200 each, which equals about 100 different contracts. But it gets more complicated than that. We have contracts that every Friday get created for at least a year to a year and a half out, almost 2 years out. And so theoretically, if you have 2 years of contracts, that is equal to 104 weeks, 52 weeks a year. We have 104 contracts out at every price point that's out there. So on the, let's say the $140 call contract.
You have to just pop it in the holder at the bottom.
I know, but it's too glary. But I'll do it right now. $140 call contract. There are 104 of these in existence, one for every week for the next 2 years. And I hope you guys can read this and understand what I'm saying, that Chicago doesn't have one listing for IBM like New York does. The New York Stock Exchange has a listing for IBM stock. That's it. Chicago has listings for call contracts at every dollar for 104 weeks each. That means there's 104 different quotes available on the 140 calls going forward the next 104 weeks, 2 years. And this is the same for the 139 contracts, the 138s, the 137s, and the 141s, and the 142s, and the 143s for puts and calls. Chicago is sitting on tens of thousands of listings of contracts trading simultaneously, mirroring the value of the IBM shares and these contracts. These contracts go up and down in price based on how the shares go up and down in price. And we are talking about 104 different contracts just for IBM. And then think about Amazon, Google, Facebook, all the SPACs we talk about, all the stocks we talk about, on and on it goes. It is an absolute miracle of technology that Chicago can track tens of thousands of contracts simultaneously as these markets move. Now, it hasn't always been this way. It was this way only in the last 10 years or so. Going back to the 70s, when I started as a stockbroker in 78, you could only buy and sell call options on IBM, for example. Right here, you could only buy and sell call options on IBM where the calls only they only were available 1 month at a time, the third Friday of every month. So 4 times a year, contracts expired and were created, and they only lasted a year at a time. So if this month's contracts died, they would now be replaced with contracts that expire a year from now. And there will only be 4 $140 call contracts and 4 140 put contracts trading at the same time. This is the days before supercomputers and the fact that we can do everything of tracking these computers in one of these things because these didn't exist in 1978. Today, we have call contracts that are at every dollar for every week, going out for 2 years on every stock for calls and puts, just to kind of give you an idea of the size of this ridiculous market. Why would investors buy into these? Basically speaking, let me clear the board if I can. Bear with me here. There we go. Why would investors want to buy into this market?
They want to know, why do some companies not show any options available, and who decides that?
That's a good question. Depending on the company, how old the company is, it's rare that a mature company that's been around a few years would not have stock options on the stock. I can't actually think of anyone that wouldn't. We have found, watching some of the SPACs that we're playing with, we have noticed with some of our SPACs that there are not contracts available on. There weren't on a couple of our SPACs. Now there's only on one of our SPACs, and the question has been asked a few times: why are no call options and put options on this particular company stock? And I can only guess that either Chicago hasn't had enough interest in it yet, or a market maker in Chicago, a brokerage firm, part of the Chicago market, a brokerage firm in Chicago has found that they have not yet. I would say it this way: the Chicago Board of Trade has probably found that no one market maker has come forward yet to want to do it because of a lack of interest, or there's maybe not enough volume on the stock right now to justify options tradings. Maybe there are not enough shares changing hands. There's not enough volatility. It could be a plethora of reasons, but sooner or later, pretty well every SPAC out there will have options on it. If that's the question, hopefully I've answered that properly. Why would investors buy stock options? Here's an example again. Just the other day, I was talking to you folks about how IBM had a bit of a tumble. This is a 5-day quote on IBM. Here's a chart on IBM that's a 5-day chart. Let me show you an IBM quote here's a 10-day chart on IBM. Take a look at IBM. At the middle of this chart, you'll see this sudden downdraft, this down dip right here in the blue line. That is the stock of IBM dropping from about the 147 mark down to about the 140 mark, and then ultimately a couple days later reaching 137. And I made a comment the other day on the show, one of my shows, where I said, hey, the stock just went from the 145, 46 range down to this 140 range and even 139, not knowing it would even go to 137, but it did. There was a management change announced for the corporation. Now, if you want to buy stock in IBM and take advantage of this dip, you could buy the stock at 139 and hopefully it'll go back to 145 and you'll make $6 for every share you buy. The problem is, and the reality is, you want to buy one share of IBM. The stock was trading at 145. It went down to 139. And if you could buy one share, you buy one share or 10 shares at $139 times, say, 10 shares, your cost would be $1,390 to buy 10 shares, obviously without commission. So most of you are able to trade commission free. If the stock goes up to 144, which is only $5 more, your 10 shares would be worth $1,440, and you would have made a profit of $50. Now, nothing wrong with making a profit of $50, but you had to spend $1,390 to make $50 profit. That's a lousy return on a correct guess, but that's the way it is for stockholders. Now, back in the day when I was a broker, you would have to have purchased at least 100 shares of these from my brokerage firm. If you wanted only 10 shares, you would have to have paid $139 plus an extra quarter on top of that as an odd lot fee, because you weren't buying 100 shares. You would have paid $139.25, and then when you sell it, you would have only gotten $143.75. You would have lost a quarter on the way out the door, plus you were still paying me a commission. You wouldn't make any money whatsoever. You would have been a loser. Even with a $5 gain, back in my day, you would have lost money on this transaction. If you bought 100 shares, of course, again, buying from me, you would have to buy 100 really to do anything. 100 shares times 139 per equals $13,900. Okay, is that awful penmanship or what? If you sold them at 144, that would turn into $14,400, a gain of $500. Again, nothing wrong with making $500, what we call gross. But in my day, I would have charged you commission to buy this stock and sell this stock and this would have been eaten up by my brokerage firm. You would have had nothing. Now today, you can do all this commission free. You can buy 1 share, 10 shares, a half a share, whatever you want, but you're only going to make $50 to $500 on a correct guess that IBM went up $5 a share and you called it right. All right. Now let's compare an option trade to against it.
They want to know what a market maker is. If you could explain more on a market maker.
All right.
And they want to know why is it called a call and a put.
A call option is named for the buyer of the contract. The person that buys a call option is in the possession of an obligation where they can call you up and say, hey, I want your stock. I have this contract here that you sold me. I'm going to call your stock at the price that you offered it for when I bought your contract. I bought a $140 call contract. I have the right to call your stock from you at $140. On the other side of the coin, the put contract buyer, the person who buys a put contract, they're guessing that the market's going to go down. They have the right to put 100 shares into your hands at $140 a pop for the $140 price. So if you are the writer of a put contract at $140 and the stock is now trading at $138, someone has the right to put stock in your hands at $140 because you sold a put contract for $140. So you can either call the stock from somebody or you can put the stock to somebody. That's why they're called calls and puts. Market makers are firms that are members of the Chicago Mercantile Stock Exchange, just like there are member firms of the New York Stock Exchange, the Merrill Lynch's of the world, the Bank of America's, the Jeffries and Company, all the brokerage houses. They're members of these exchanges. As members, they have the right to buy and sell stock. But as members, they also have the ability to be apply to be market makers for either shares like IBM. They can make the market for the stock and always make sure there's a good bid and a good ask, a nice tight spread between buyer and seller at all times for stock. And in Chicago, you have market makers for options. And the market makers for options always make sure there's a buyer and a seller, or there's a bid and an ask on every contract at all times, all day long, on every single contract that exists. That is the deal that a market maker makes with the Chicago Mercantile Exchange. The Mercantile Exchange is saying to a market maker, yeah, you can make the market on GameStop shares. You can make a market on options for SoFi or any of the SPACs, a lot of them. But you have to have a buy order, a bid, and an ask on every contract at every price for every contract that exists for all the way out. That's the obligation of a market maker. So in effect, the market maker is adding to liquidity of a contract or of a stock, of IBM stock, for example. So the shares always have liquidity, contracts always have liquidity. The key here is that for you as a buyer or a seller of stock or of contracts, you know there's always a bid and there's always an ask. Now, it might not be the price you want to sell for or the price you want to buy for, but there's always a price for the entity you want to acquire. Now, what I will explain it as, the way I explain it is, a market maker gives us an indication of the value of the item. So the market maker is telling us that, say, on IBM stock, if it's trading at 139 at the low, it might be 139 to 139.10. And that's an indication of the market. Now, the buyer and the seller might be a market maker, not even an average shareholder. A minute later, there might be a 139.01 buyer and a 139.09 seller. And those two buyers and sellers are actually shareholders. Traders. One is a seller selling, one is a buyer trying to buy. The last trade might be 130.05. And you look at the quotes, they change all the time, second to second, nanosecond to nanosecond. And it's rare that market makers have to make markets on IBM unless there are dramatic moves on IBM, which is what we saw here, what I was just showing you on this chart, where it went from 145 to 139 in an hour. On options, it could be that an option that is a 139 option when the stock is at 139, that is what we call an at-the-money option. That option out there, all the 139 options are right at where the market is at, 139 a share. That's an at-the-money option. Those will trade the most. the 141s and the 142s and the 143s on the call side, they will trade less. The further out you get, they trade less and less and less. The further down you go, from 139 to 38, 37, 136, 35, those contracts will trade less than the 139s. The markets are the most active right at the money itself, because that's where most of the action is. But stocks move, as you've noticed, they do. And as they go lower, the options action now leaves the 145 area and starts entering the 143 area, the 142 area, now the 139 area. That's where all the action is. There's still volume everywhere else, but not as much as at the money. The market makers won't have to work too hard to keep a reasonable market between bid and ask and a 139 contract if that's where the stock's trading at. But if the shares were at 145 yesterday or a week ago, they're still in need of a bid and an ask. And the market maker will always make sure there's a bid and ask on all contracts at all times. That's part of their obligation. It could be that the contracts trading at 139 have only a 10-cent spread between buyer and seller. But at 145, there might be a 25 or a 35-cent spread between buyer and seller. On SPACs that you guys are watching, when you're taking a look at option quotes on a SPAC, say, let's take a look at, say, SoFi. SoFi's trading at $16 a share. A 1750 contract or a $15 contract, there might be a 50-cent spread between bid and ask on each of those contracts. Whereas the 1250 contracts and the $20 contracts, the further out they are, they might have a $1 difference between a buyer and a seller. Those markets are made. Those bid and asks are posted by market makers. Now, I've always said to you, if you want to buy a contract and you see the market from $2 bid to $3 ask, I tell you not to just go and buy it at $3. I tell you to put a limit order in to buy it at maybe a nickel above the highest bidder. The bidder is $2. That might be a market maker. You're in at 205. You just put in a 205 bid there and wait. You may or may not get it. But at least now the market is 205 to 3. If you're a seller of the contract, let's say you bought it at $1 and you want to make a profit, you see the market at 2 to 3. You can sell it at 2, but I wouldn't recommend you do that. Again, that's a bid ask set by a market maker, or even a 205 bid by a buyer, 205 to 3. You might be offering it at 295, 5 cents below the seller. Now you're the cheapest offerer, you're the cheapest seller, and at 205, you're the highest buyer. You now are making the market. You have one buyer who really wants to buy this contract, and one seller who really wants to sell these contracts, and the market is now 205 to 295 instead of $2 to $3. The market maker will stay out of the market now. He or she will no longer be the bidder and the offerer in the front line. They will still keep their $2 bid and their $3 offer behind these other orders to maintain a market. And if other players come in, there might be 210 to 280s and 220 to 270 bids and asks coming in as this market tightens up. And there might be a buyer who comes and says, I'll buy 5 contracts at 250. And someone on the sideline goes, oh, I'm going to sell 5 at 250. I'm happy to take that price. And they just offer it right at 250 and the trade is done. The market is 220 to 280, last to 250. And there's all kinds of buyers between 2 and 240. And there's all kinds of sellers between 3 and 370 or 270. The last trade was at 250. On this contract here, the 139 IBM contract, it might be a 5 cent spread, 10 cent spread between bid and ask. And they're trading all the time between these two prices, all the time. And as the stock drifts higher or lower, the bids and asks drift higher and lower, both all the time. Market makers are constantly monitoring every stock at all times with their computers to keep a reasonable market between bid and ask. That's a long answer to a short question. Another question.
How can we tell if the option price is current?
Generally speaking, the bid and ask are current. So the buy price and the sell price is a current price. The last trade, though, may not be current. And this is something you have to realize with new companies listing like SPACs, starting to trade options on SPACs. It could be that you have, say, Gores Holdings or NSH or any of these outfits. There are now contracts available on a lot of the SPACs that we're following. But the market is so new and is so infantile that the 99% of the stock market does not know who these companies are or what they do or what they're going to become. Yet there are options available on these things. And you may find that the bid and the ask is quite wide between buy and sell. And the last trade might be odd to you. You might see say a 250 buyer and a $3 seller, last trade $330. And you're looking at that going, that doesn't make any sense. The last trade was 330 and it's offered at 3 and the stock is up 15 cents right now. Because you're looking at the quote on the market going, it's up 15 cents on the day and it's a $253 market. Last trade at 330. This makes no sense. Well, what you don't know is that the 330 last trade was done yesterday or the day before yesterday. It hasn't traded in a couple of days. The bid and ask always move with the stock, and the bid and ask may have gone down between 2 and 250 and have come back 250 to 3 as the stock started to come back up again, but no trading has taken place. None. The market maker is constantly moving the bids and the asks with the stock price as it goes up and down to mirror it, to keep a bracket around the price of the stocks. The stock's here, the bid and the ask are here on the contract, constantly mirroring the stock, minute to minute, day to day. But options may or may not trade every single day on some of these out of the money contracts or way in the money contracts, or even some options that don't trade very often. For example, contracts that expire in the next week or 2 or 3 or 4, those trade a lot and they'll trade actively because they're going to die soon. They're going to die out. Contracts that have 6 months, 8 months, a year to go, they don't trade as often yet because they're not yet coming to expiry. And so the urgency isn't there to trade those and figure those out. But with a contract that has 5 days left to go, 3 days left to go, those trade very actively in the last 3 days of their lifetime. The bid and ask spreads really get tight on those contracts as they're about to die out because people have to make moves before they expire. Another question.
So we have some people who are lost. You need to go back to the basics. And one of the basic questions is, so you're saying we're not buying the 100 stocks, we're just buying a contract.
Yes.
Yes. So if you still have to buy the stock.
Okay.
Yeah.
All right.
So yeah,
Let's get back
to the basics.
Let's go back to this example over here on IBM. And again, I'm going to make it really basic. Like I said earlier, when the stock reached 139 a share from having been at 145, you could have bought stock at 139 in any quantity you wanted. In this example, I showed how you could buy 10 shares for $1,390, or you could buy 100 shares for $139, or anything in between, or you can buy 10,000, whatever you want. And then you can sell. If you sell them down the road for a higher price, you make money. But let's say you want to be an option buyer. You want to buy a 139 option contract, because you think the stock will also go up to 144, but you don't happen to have $13,900 with which to buy 100 shares, but you can buy a call option for 100 shares to control 100 shares, right? There, you can control 100 shares for a whole lot less money than this. This is the beauty of the options market. To give you an idea,
That's your leverage.
that's right. There were viewers of mine this past couple of week and a half, who were saying to me, I'm looking at buying August contracts. This now being July the 10th, there were folks looking at August contracts that were expiring in the latter part of August. And they were looking to buy a 139 call option, all right? 139 call option that would expire in the latter half of August. The cost of these options were about $2 a piece, all right? So I'm just going to use this number here, $2. But the option is not $2. The option represents 100 shares. The actual cost of this option to anyone who's buying it is $200. It's $2 a share times 100 shares, which is a contract, and that equals $200. Now, for $200, the person who bought this call option is actually controlling or has the opportunity to enjoy the upside of 100 shares at with a 139 strike price. So stock's trading at 139. You bought a 139 contract, cost you $2 a contract, $200. What if the stock does go to 144 a week later, which it might yet do? It's right now 141 to 142. But let's just say it goes to 144 next week for fun. Goes to 144 a share. This contract, this 139 contract is, I'm not going to take off my stilts because I'm way down here now. This contract is now worth $5 a share in book value. The difference between 139 and 144 is $5 a share. This contract is actually got value to it because in theory, if you own this contract, you can buy stock from the seller of this call for $139 a share, but the stock's trading at 145 or 144. That's $5 difference. The other reality, the other thing to remind yourself of is that this contract still has life left in it. It lasts until the third week of August, theoretically, which means it might have a $5 actual value, 144 versus less than 139, but it also has time value on top of it. It still has 5 weeks to go before it expires of old age. And in effect, that could add another $1 contract or dollar a share to the contract value, giving it a $6 value or $600 in total value. And if you can read that way down here, you pay $200 to get the contract. The stock went from 139 to 144. You can sell the contract back into the option market because it is now trading at about a $600 value. Because again, the option will trade based on where the stock goes. The market makers that are always monitoring these markets, they are bracketing their options, buys and sell prices around the price of the stock. So if the shares go up to 144, the contract will go up to the $600 level. That's what you can sell it for. You'll never buy the 100 shares at 139. You'll never ask to call them into your hands. You're just going to take your $200 that you spent to get this contract and sell it into the market for $600 and pocket the $400 difference. You, in effect, have made a $400 profit by using $200. You tripled your money. Where up here, you made $500 profit by buying 100 shares and selling 100 shares. You made a profit of $500, but you had to put up $13,900 to get the 500. Down here, this person put up $200 to make a profit of $400. The difference between 600 and 200. And so, what would you rather be doing? Spending $200 to make 400 or spending $13,900 to make 500? There's your difference. If you were to buy 10 of these contracts for $2 each, $200 a contract, you would have spent $2,000 to buy 10 call contracts. You would have sold them for $600 each, $6,000, making a profit of $4,000 in profit. You still only spent $2,000 to make $4,000. Here you're spending $13,900 to make $500. You're beginning to notice the leverage of a call option. If you were to spend $14,000 roughly, it's not quite right, but $14,000, you could buy 70 contracts, 70 of these for $14,000. If you make $400 a contract on 70 contracts, it's $400 profit times 70 units, $28,000 in profit. So for the amount of money to buy 100 shares and sell 100 shares and make $500, you can buy 70 call contracts, sell 70 call contracts from $2 to $6 and pocket $400, which is $28,000 in net profit for the same amount of money that you would make with $500. This is why call options are so incredibly popular among option players. Now, you never had the $14,000 to buy in the first place. If you didn't have $14,000 to buy just 100 shares, but you did have $200, $400, $600 lying around, you could have picked up 1, 2, or 3 of these call contracts to control 1, 2, or 300 shares of IBM's upside. How much money, though, can you lose on these two transactions? Here's the big question. What if the shares go from 139 to 109? They drop $20 more. You're going to lose $2,000 over here because you spent $13,900 to buy 100 shares at 139. You go down to 109, they're only worth $10,900. You've lost $2,000 on your deal. Down here, you spent $200 on this contract, or $400 to buy 2, or you spent $2,000 to buy 10. You can only lose what you put up on this bet right here. So on the 100 share comparison, to buy 100 shares, you paid $13,900. To control 100 shares, you paid $200 down here. You can only lose $200 on your call contract. If the shares go down to 109 and the end of August comes and goes, this contract is worthless. It has zero value whatsoever. You've lost all $200 of your money. That's the risk you have to take. But you still didn't put up $13,900, did you? And you didn't lose $2,000 on your stock, because this is worth now $10,900, or roughly $109 a pop. You've lost $2,000 on this transaction. Here you've lost $200. There's the difference. Do I have any more questions?
Who do I know I'm selling to? But it doesn't matter.
It doesn't matter.
It doesn't matter.
You might be selling you might be selling this call contract into the marketplace when, let's say the market is 575 to 625. At the time that the shares have reached 144, the bid ask, there's a buyer for 575, there's a seller at 6.25. Those two prices could be a market maker. The likelihood is, though, that the option won't have that kind of a spread, because if the stock is trading at 144, this contract, well, it might have a 50-cent spread, but it might only have a 25-cent spread. The market maker will always have a bid and an ask around it. But you're sitting there going, I paid $2 for this contract, and the stock has gone up $5. I would like to cash in here. What should I sell it for? Well, you know a couple of things for sure. You know that it's a $139 call contract. You know the stock's trading at 144 a share. So you know that there's a $5 difference between your exercise price and the stock price on the open market. You know that for a fact. That means that your contract has a $5 per share actual value to it, because it's in the money by $5. The stock is at 144 and you have a 139 price that you can get it at. You also know that there's still 3 or 4 weeks of time left in this contract's lifetime before it expires. That'll add about $1 a contract onto it. So it should be worth around the $6 mark. And so in your mind, you might say, I'm a seller at $6. You give me $6, I'll take it. The market is 575 to 625. You put in a sell order at $6. And you just put it out there. Say, I'm prepared to sell. Just like you were a buyer, you were a finicky buyer, but when you bought this contract, the market might have been 180 to 220. You put in a buy order at $2, and after an hour or so, you got a confirmation that you just bought this contract for $2. You're doing the same thing on the sell side. You're putting it up for sale in between the bid and ask. You don't have to if you don't want to. You can literally just go to the 575 buyer. You can enter onto your phone and order to sell your contract at 575, and you'll get an instantaneous report back from your broker going, you sold your call at 575. But if you offered it $6 in between, right between the two, the buyer and the seller, right in the middle of that market, you're offering them. These shares are trading at the 144 level, 143.95, 144.10. They're jumping around. Chances are pretty good if you're in the middle of that bid ask that you're going to get taken out. You don't care who the buyer is. You don't care who you bought it from. You don't care who you sold it to. It doesn't matter, and they don't care either. You might be selling it to a market maker. You might have bought it from a market maker. You may have bought it from someone who bought it from a market maker 3 days earlier. You might be selling it to someone who's going to sell it to a market maker. You don't care, because they don't care either. It's just the market. It's like when you buy and sell the stock here. You don't care who you bought it from. You don't care who you sell it to. You're just playing the market on the stock. You're doing the same thing on the options. And that's how that works.
I buy a call contract for $200. What happens if the stock doesn't really go up or down and it just sort of stays where it is?
Okay, let's talk about, you buy a call contract and nothing happens with your stock. Okay, we can talk about any stock we want. It doesn't matter. All right, so let's just go with the IBM. We'll just keep going with the IBM. All right, so IBM. All right. All right, can you see her? You can see, okay. All right, so the stock was trading, let's see, the stock's trading at $140 a share. All right, that's the price on the open market. And today is July the 10th. All right, this is today's date. And you're looking to buy a call contract because you think the shares are going to go up in price. All right. So you're looking to buy, you can buy whatever contract you want, depends on how much you want to spend on it and how long it is. The longer the life of the contract, the more expensive it's going to be because of how much time it has. Contracts have various ways of having value. One way a call contract can have a value is something like this. You want to buy a 135 contract that has, let's say this contract has 3 months to go before it expires, and another one has 6 months to go before it expires. Just to kind of give you some ideas here of timing. A 135 contract is $5 in the money right now. The stock's at 140, and you're looking at buying a call contract with a 135 strike price. A 3-month contract and a 6-month contract will have different values, because this contract has 90 days left to live. This one has 180 days left to live, okay? So Again, this is just theoretical. I'm just giving you some ideas. It's $5 in the money because the difference between the market and the stock price is $5, and time on top of that. This contract here could be worth something around, say, $7.50 a piece, which would work out to $750 for one contract, $100 a share. This contract here could be worth about $10 a piece. The extra $2.50 in price is extra time. You're buying time, 180 days of time. Now, let's take a look at another contract, and I'll give you answers to all of this here in a moment. A $140 contract, which is right at the money, right where the stock is right now. This contract here has no book value at all. It's equal to the price. It only has one value, time. It's the only thing it's got. This one here would have probably a $250 price tag on it, being a 3-month lifeline, and this one will likely be worth about $5 because of how much time it has. That's the 140 contract versus the 135 contract. This contract has $5 book value plus $250. This one only has $250 on it. Time. This one has book value and time. This one has book value plus time. This one has time only. And you can see the difference in cost. So to buy this contract is $250. This one is $500. This one's $1,000. This one's $750. Those are your basics. All right. Now, let's take scenario number 2. The stock doesn't move in price, and we have, let's say 2 months goes by. We have 2 months gone. What are we looking at now? All right. The 135 contract now has only got, instead of 3 months left, it has 1 month left to live because we've lost 2 months. And this contract, which had 6 months, now has four months left. All right. Hope you can see that. All right. The 135 will not be worth $7.50 anymore. It is still worth $5. The difference between, and I'm assuming the stock's at $140 a share. Like we said, it's not moving. So the stock is at 140, still the same. This contract still has a $5 book value to it because it's $5 in the money, but the time is running out. And instead of trading at $7.50 now, this contract will likely be trading at about $6. This contract here also has lost time. Instead of trading at $8, at $10, it is likely now down to about the $8 mark. It is losing value. So as a contract investor, or as a buyer of a contract, you paid $7.50 for this one 2 months ago. It's now trading at $6. This one used to trade at $10. It's now trading at $8. This guy right here, the 140, this one has also lost value. It was at $2.50. It's probably trading at about $1.10 right now, maybe even less than that. This one here that was at $5 is probably trading now at about $3. Because it is losing time. It's still more valuable than this one used to be with 3 months because it's got 4 months to go, but it's down now to $3 in value. And so you're noticing how this contract went from 5 to 3. This one went from 10 to 8. This one went from 750 to 6. This one went from 250 to 110. They are losing time, which means they're getting old and they're going to die in 30 days. If these shares stay at 140 for another month, one more month, these contracts here, this one will only be worth $5. It'll lose all its time premium, but it'll keep its book value. This one will be worthless, will have zero value because there is no book value and there's no time value left. This one will be worth $5 plus 3 months of time premium. It'll probably be trading at $7.50, where this one used to be. It'll now be the 3-month contract. This contract here, out of the money, but with 3 months to go, will likely be trading at $2.50. So it went from 5 down to $2.50 at the after another month, where this one here disappeared right off the existence. This one disappeared, but still had a $5 book value to it. Time marches on, and time really is money. Money disappearing is actually what it is. So if you are a call contract buyer, your strategy is, I want to buy a call contract today because I think in the not too distant future, the stock that I'm following, like IBM here, is going to go up in value. And I think it's going to go up in value rather shortly for whatever reason it is, whether because of what I mentioned the other week about how the stock took this unnecessary drop from 145 down to 139, ultimately down to 137. And I figured going back to 142, 43 wouldn't be a big stretch to have it go partially on the way back. There's some money to be made here. Or you're expecting earnings report to come out. Maybe there's a third quarter of earnings coming out in 2 weeks, and it sounds really good. The company's on fire. Maybe you know a friend of yours who works with someone who works at someone who knows someone at IBM who's saying to you, oh, they're hiring like crazy and they can't keep up with the orders, and they made this deal to acquire this company and they're just bringing all kinds of money. That could be what you're hearing or what the analysts are talking about on television. You're going, oh, Intel is on fire. They're doing really well. Or Apple, their numbers are just incredible. iPhone sales are wild. You want to buy call options because you're thinking in the short term, the shares could have a bit of a run here. And for not a lot of money, you can control a lot of stock and score a nice little return. That's what call option trading is about. Now, when I talk about buying call options for SPACs, SPACs sitting at, say, $10 a share or $12 a share or $15 a share, what I'm thinking about is in the next 2 or 3 or so months, as these SPACs now become non-SPACs, as they get taken over by these private companies and they change their name, like Gore's Holding will become Matterport, SoFi is already SoFi. These shares could have a run in their first 90 days of existence as new publicly traded companies. And if that's the case, there could be a wonderful profit made on call options. But to avoid getting caught in this problem right here, where you buy a call option that only has 3 months to live, and that could be going from 250 to 110 to 0 in 90 days, instead of getting caught with that, you buy a longer term contract, a contract that has longer to live. You pay a bit more for it than you would on a shorter term contract, obviously, but you now guarantee yourself more time for a call option to give you a return, hopefully the return you're looking for. So if in the first 90 days, the shares do have a bit of a run, down dips, up dips, but ultimately they have a bit of a move. These call options that you bought 6 months out will go higher, of course. They'll likely be in the money now, and they'll still have a lot of time premium left to them. You might pay $250 for a call contract and sell it for $750. Well, that's a $5 or $500 return per contract. If you have 10 contracts, that's a $5,000 gain on your investment. Wonderful leverage on the move. Obviously, if you own the stock itself, it also will rise with it, with the tide. Obviously, you'll make money on the stock, but you may have 5 call contracts and only 100 shares. You might have 10 call contracts and 300 shares. Those 10 call contracts will make you much more money on an up move than 200 shares would for the same values. Any more questions have come in that I need to?
Lots of conversation on buy to open, sell to close.
Okay.
And asking if you could do this exactly the same example you have here, but use SoFi instead. Also, they're asking, how do they determine the time premium? Is there a formula? Is there ever a case where you can't sell your contract or you can't buy a contract?
There'll never be a
That's
case.
Robin Hood question.
There'll never be a case where you can or cannot sell your contracts. They are monitored by the Chicago Mercantile Exchange. They take this very seriously. It is all they do. They're in the options business. They have options specialists on all contracts who must have a market on contracts at all times. Even at the end, in the last 3 hours of the day, Fridays, every Friday options expire on everything. Even in the last minutes, the bid and ask gets tighter and tighter and tighter and tighter, right around either the book value of the contract, or it goes tighter and tighter to 0 because it's out of the money. Of course, if you're involved in, say, an IBM contract that expired yesterday, The stock closed at say closed at 141, and you had a 142 call contract, it died worthless because the call was out of the money. It was at 142 when the market was 141. If you had a $140 call contract on IBM that expired yesterday and the stock closed at 141, it had a $1 value at the very end of the day because it was in the money, $1. The option specialists are keeping bids and asks on all contracts right up until they expire, right to the last second of the day. That's their jobs. And they will offer you within a penny or two the book value of the contract right at the end. So if you are one of those gamblers who you're sitting on 10 contracts and you're going, oh, I got 140s and we're trading at 140.80 and 1 to 141.20 and I'm going to try to score a deal here, and you're watching the quote and the bid and the ask and the quote and the, and it's the stock is jumping up and down in the last 5 minutes of the day. You can sell your contracts right up until the last minute of the day. I don't recommend you play this game because sometimes your computer crashes on you or you got a bad internet connection. You don't want to play this game. But in the last 20, 30 minutes, you can buy and sell your contracts if you need to. If you need to sell a contract, you can get out. If the 142 player, the guy with the 142 contract, they're out of the money when the stock's at 141 with half an hour to go. They're a buck out of the money. That contract may still have a nickel value, might still be worth a nickel. The market maker may still offer you 5 cents for that contract if you want to sell it to them. You're only getting $5 a contract. You got 10 of them, you're getting $50, but you could still get out. Of course, if in the last hour, the shares go from 141 to 141.25 to 141.50, the market maker might offer you a dime for those contracts. They're not in the money, but they're not way out of the money anymore either. I can guarantee you the 143s, the 144s, and the 145s will have no value whatsoever. The market maker will put a 1 penny bid on it, if any bid whatsoever. There may not even be a bid because it's going to die in an hour and it's $5 out of the money. There'll be no value to it.
So talk about what happens when a contract expires and you didn't have to exercise your right.
Okay. If you have a $140 IBM contract and the stock closes at 141 and the option is now dead, depending on the brokerage firm you're with, they usually and will likely sell you out at the very end for the value of the contract, the actual book value, and you will just be paid out. Unless you notify your broker and say, I would like to exercise my option. I want to call the stock. I can buy it for 140. It closed at 141. I'm calling in the stock. Here's $14,000 in cash. I want those 100 shares. Well, all you need to do is you contact your broker, probably with the 800 phone number, because I'm not sure you can do it on your telephone with a button. It might be, but you would contact your broker and say, look, I got 20 grand in my account. I want to call the option. I want to exercise my option to buy that stock. It's a rare move. It makes no sense economically to do so, but you have the right to exercise your call if you would like to. All right. If you refuse to sell your contract, but you decide you want to call the stock, you can call the stock. Let's talk about SoFi. You want a SoFi example? Let's do a SoFi example. Let me see if I have some SoFi quotes here. This is a quote for 1 month. So there you go. There's a SoFi quote for 1 month. We'll take a look at that. If you were a buyer of call contracts on SoFi for the last few weeks or so, you have not been having a good time, because you'll notice that the blue line here has, from the far right, gone from the $22 level into the $22.50 level, and then down to the 18 level, and now in just above 16. So the values of the value of the stock has dropped down to 16.48 in the last 30 days or so. Not a pretty picture, but it's reality. And you've got to ask yourself, today, you have to ask yourself, well, if I own any of these contracts, what should I do with them? If I don't own any contracts, what should I do, if anything? What's my mentality here on this? If you're a person who's thinking a stock is going to go down in value, you have to be thinking to yourself, should I buy put contracts? Because they'll go up in value if the stock goes down. It's the opposite of calls. And I don't have to sell anybody any stock. I can buy a put contract. If the stock goes down, I just sell the put contract and I make a profit, just like I would with a call contract. Because I'm just an investor. I'm a trader. in stock, and I'm looking either make money with the stock going up or the stock going down. I don't even want to own these shares. I don't want to own any of them at all. I just want to make money on the movement of the said stock. Okay, so you could be looking at SoFi, for example. A couple of weeks ago, 30 days ago, they were trading at SoFi. Let's write this up here. SoFi. Okay.
And talk about like
Yep.
putting limits on your buy and sell orders, and can they put limits on their buy and sell orders?
Okay. All right. SoFi shares were trading at $20 a share a month ago. Okay. They're now trading at 16. Let's call it 16.50, just to round it out. They're now at about 16.50. Okay. The question is, the wonderment is, well, you know, Bruce, this stock's gone way down too far, too fast. What if in the next month or so the shares can go back to $20? Can I make any money in this business? Well, yes, you can. You can either buy the stock itself at $16.50 on the open market, like we've talked about before, or you can try to buy call options. Now, which call options should you get? And I have been saying to all of you out there, if you watch my live shows, I am suggesting that you buy call contracts out till next January, this being July, because this gives you like 6 months of time for any kind of a recovery to happen from the 1650 level. I mean, anything. If the shares just go to 1850, you'd make money on these contracts. Buying them today, of course. If you'd have bought contracts back here, and I know investors of mine that have. They bought shares at 20. They bought shares as high as, I think, even $24. They even bought shares as high as $24. Contracts, I should say. But now we're at 1650. You can buy call options that have strike prices of say $15 each. The strike price is the price of the contract where you have the right to call the contract to buy the shares. So you're buying $15 call options. You have the right to buy shares at $15 from the seller. You can buy 15s, you can buy 16s, 17s. They go up in various increments. Now the contracts that expire in the next month or two apparently are now going out at 50-cent increments. So you can buy 15s or 1550s, 16s, 1650s, and 70s. This will eventually be the normal for all of SoFi contracts. The first contracts were available when we first were watching SoFi over a month ago for options trading, even 2 months ago. They were every 250. They were like 15s, 1750s, 20s, 2250s, 25s. But now the strike prices are narrowing in because the options specialists in Chicago are seeing more interest in SoFi contracts because of the interest in the selling and buying of the shares. The volume is going up on the stock. That means volume is going up on options. And so the market makers start to come out with new strike prices where they were literally offer for sale contracts at every 50-cent level, even though they don't own the stock. They are literally writing naked contracts. They are creating contracts out of thin air that we can speculate on, and they know at the end of the day, we're just going to sell them off at the end of the day for a profit. We're not going to exercise them. They don't have to worry about exercising the stock. They will just offer the market. They will offer liquidity for all of us at various strike prices. The buying and selling of call options with different strike prices. So we have the opportunity to buy a $15 contract. We have an opportunity to buy, let's say, a $17.50 contract, which is what we've been talking about on the channel lately. I'm over here, folks. Don't worry, I haven't gone away. And then there's the $20 contracts. Okay, there's 3 levels of contracts that we're going to talk about here, and we know the stock's trading at $16.50 at the moment, roughly. We're going to talk about buying January 22 contracts because this is 2021. So we're talking about January 22 contracts. 15, 17, 50s, and 20. At 1650 right now, these contracts have different values. January 22 contracts, $15 strike price. The last trade was about $4.70. I'm rounding up by pennies. It doesn't matter. $4.70 was the last trade on Friday night. The 1750 contract closed at $3.80. Here we go, approximately. Yep, and that's accurate. And then the $20 contract closed at $3.20. And I'm just taking a look at, $3.20. The board is moving because I don't want the glare on you. So 320 is where this contract closed at here. Sorry, folks, can't read that too well. There you go. All right, that was Friday's close. All right, now let's just suppose next week is a good week. All right, it's a great week. Finally, we got a move on this darn stock, and it goes to $18.50 a share. All right, it gets there sometime between Wednesday and Friday. It reaches $18.50. Even if it's there for an hour, it gets to $18.50. What will these contracts be trading at if the stock goes up $2 a share from $16.50 to $18.50? That is the trick question. And here's the trick answer. They won't go up $2 each. The thinking would be, well, if the stock goes up $2, Bruce, the contracts will go up $2 each, because after all. But no, that is not what's going to happen. Right at this moment in time, right now, the $15 contract with a $16.50 stock price, this contract is $1.50 in the money. You can buy the stock for $15 and it's trading at $16.50. It's a $150 book value. You take $150 away from $470 and you get $3.20, and that is the time value on this contract. After all, it expires in January of 2022. It's got a long time to go, all right? But if the stock goes up $2 a share, this contract will not go up $2 in value. The likelihood is that this contract will rise by about $1. And let me show you what we have happening if that goes on. If it goes to $5.70 in price, it is now in the money from 15 to 18. It's now in the money $3.50, right? It used to be in the money $1.50, $16.50 to $15 contract, $16.50 price, $1.50 in the money, $3.20 premium. $3.20 time value. Okay, there's a little watch in the clock. All right, $3.20. This contract is $3.50 in the money. We take $3.50 away from here, and that leaves us $2.20. That's mathematics 101 with Bruce. That means we have $2.20 time value left on this one. You'll notice how this is dropping? Because it's more in the money. All right. This contract right here is at the moment out of the money. It's a $17.50 call with a $16.50 price. It's out of the money. It's a dollar out of the money. But if the shares go to $18.50, this is now $1 in the money, just like this was $1.50 in money. Now this is again. All right. If the stock is trading at $18.50, the $17.50 call is in the money, because you can call the stock for $17.50 if you own this contract. It's now $1 ahead or below where the stock is trading at right now, $18.50. All right. So it's $1 book value. The rest is time value. But if this, as I say, the shares go up $2, this will not go up $2. This will likely go up about 75 cents in value. So it's probably going to reach about, let's call it $4.55. And we take from here, we have the $17.50, $18.50, $1 of book value. It is $3.55 time value on this one. Here, it was all time value. This stock was out, this contract is out of the money. The stock's at $16.50, this is trading at $17.50. This is out of the money. This is all time value, $3.80. The time value will now drop to $3.55. This last one here, the $20 call contract, it's out of the money because the stock's at $16.50. If the stock goes up $2, it'll still be out of the money because it's a $20 contract with an $18.50 market price. But it will go up in value, but probably only by about 40 cents or so. It'll probably reach about $3.60 in value. But this here is all time value, and this is all time value. So you can see how the time value goes from 220 to 355 to 360. Whereas right now the time value is 320, 380, and 320. Hello.
Let's take an example. Take one of these and tell them how they would exercise it.
They would exercise it?
Yeah. Like how to explain to them that if you do, you would still have to pay for the stock.
Okay.
Because some of them aren't understanding that part.
Okay.
That this is just the right
Again,
to buy a stock. You have to buy the stock.
If you own a call contract on SoFi or any stock, you have purchased the right to buy the stock at a set price for a set period of time if you choose to do so.
Right.
You're under no obligation
Right.
to do any of this whatsoever. So even with the $15 call option, you buy this now for $470. If you bought this Friday night for $470, you paid $470 for the right to purchase 100 shares at $15 a share from the creator of this contract, in theory, which means that you've got to come up with $1,500 to buy these shares, plus what you've already paid for the contract. You paid $470 to get the contract. You buy the stock for $15, you're paying $19.70 in total to buy this stock. Now, why would you pay $19.70 to buy the stock if it's only trading at $16.50 right now? Because you have until January to do so. Because here's the payoff on the big picture. Let's assume that by the end of this year, December 31st, 21, the stock reaches $25 a share. It really takes a pop and it goes to $25. This $15 contract over here will be in the money by $10, and it'll still have a month left to live because the contract lasts until January, roughly 25th or so. This contract will be worth about $11 a share at this point in time right here. All right. Now, you have the right, being the owner of this contract, you have the right to buy 100 shares at $15 a share if you want. You have a stock sitting at $25 a share now over here. You are buying this for $15. You paid $470 to get the contract. You're into this deal for $19.70, but the stock's at $25. So you're ahead all $5.30 on this entire deal if you just exercise the stock. But you're not going to do it. I'll tell you why you're not going to do it. Because you bought the contract for $470 right here. This is what you paid for it, $4.70 a share. You can sell your contract over here for $11 a share. The difference between this price and this price, what you paid for the contract and what you can get for the contract, is going to be about $6.30 if I got my math correct. If I got that right, 470 plus 70, 70, 70. Yeah, so this is a profit here. So you've made a profit of $6.30 by just selling the contract into the option market. You're never, ever going to exercise your options. Ever. Never. Listen to Uncle Bruce. Nah, da. You're not going to do it because you're going to make your money right here. You're just going to make your money on the price movement of the stock and the gain on your investment. You paid $470 to buy one of these, or $4,700 to buy 10 of them, and you sold one for $1,100 or 10 for $11,000. You either made $630 on one contract, or if you did 10 of them, you made $6,300 in profit between July and the end of the year. That's how this goes. Now, this stock goes to $25 next week. Just all heck breaks loose, and it goes to $25 next week. This contract will go from the $470 level to at least $11. It'll probably have a $12 value because next week means this contract still has 5 months to go. I mean, what if the stock goes to 40 by December? I mean, if it went to 25, it could go to 40. So you're here to make money on these contracts. You're buying a call for $470 and you're looking to sell it for $11. Even if the stock only goes up $2 though, right here, and you sell it for $570, you took a $470 contract, sold it for $570. You made $100 a contract. You got 10 contracts, you made $1,000. So you can buy the stock at $16.50. That's $1,650 for 100 shares, or you can control 100 shares for $470, or you can control 100 shares for $380, or you can control 100 shares for $320. The further out you go, the cheaper the contract is. But I look at this price between $3.20 and $4.70, and I say, don't buy the $3.20 contract. Don't buy this one. Buy this one right here, because this one right here will go higher faster because it's going to be in the money. It's already in the money now from 15 to 16.50. It's in the money now. At $18.50, it's $3.50 in the money. At $25, it is $10 in the money. This is the upside of this one here. That's why you want to do that. All right. This one here, the $17.50 If the shares go to $25, it's $7.50 in the money with about $1 premium for time. It'll probably be trading at $8.50 a share. Wow, am I bad at that? That's an $850 profit. This one here will be $5 in the money. The $20 contract will be about a $6 contract on the open market. That's what it'll be worth. So you will take $320, turn it into $600. You'll take $380, turn it into $850, or you can take $470, turn it into $1,100. And there's your differentials. You'll make $630 profit on this one. You'll make what do we got here? $470, I think, profit on this one. If I got my math right, I'm having trouble with my math today. $770, $850. Yep. And then this one, $320 to $6, $280 profit, $280 a share profit here. So you can see the profit gain on this contract. You make $630. This one you make $470. This one you make $280. True, you didn't pay as much. You only paid $320 on this one versus paying $470 on this one. The difference for $1.50 more, $150 more, you make this much more in profit to you on a contract on a stock that goes up to $25 on SoFi. Hope that made sense. Any questions?
Many.
Okay, many. Oh no, go ahead.
There ever a time when I would want to buy the stock, and if
To
I
exercise it.
Yeah, to exercise your right.
Exercise the
To
contract.
exercise your contract.
No,
So,
no,
no.
no.
If you want to buy the stock, you would buy the stock. What you're doing here is taking advantage of the leverage of an option, right?
The leverage. That's right.
Yeah. Let's buy a put.
Okay.
Let's look at the other side of the market, because there's many people who think the bear market is just around the corner.
Right.
Let's talk about puts.
Let's use SoFi again. Okay.
Yeah, use your SoFi.
SoFi shares. They're trading at $16.50 right now. Puts. All right, we're going to do put contracts. We're going to do January puts for 2022, just like we did calls.
Excellent.
We're going to look at different put contracts. Let's do 15, 17, 50s, and 20s. Okay, so $15 exercise price, $17.50, and 20s. All right. Friday night, last night, the 15s were trading at about $3 a piece. I'm just rounding this out a little bit for easy peasy mathematics. The 1750s closed at about $470, and the 20s closed out at about $6.50. All right, $6.50 each. Now, you notice with the call contracts, they would go down in value. The put contracts go up in value because they're the opposite of calls. So the $16.50 price of the stock, you're going to buy one of these put contracts, not because you think the stock's going up in value. You're going to buy one of these because you think the stock is going to go down even more. All right. Now, if you believe you're one of those guys who thinks the hedge funds are right on it, they know what they're doing, these guys are geniuses, this stock is going down to $10. You're going to make money going down to $10 a share. What happens? All right. So let's take a look at this supposedly scenario. The stock reaches $10 a share, and it does so in the next, say, 2 months. Really not too long from now. So this is July. Let's say this happens by let's say this happens by August. Gosh, that lid! I got to stop playing with the lid. The August 30th or so, the end of August, stock's going to be $10 a share. Just a disaster. Interest rates are going to go to double digits. Dogs and cats sleeping together. Ghostbusters rule. Okay, so we have a terrible situation. The stock is going down $6.50 a share down to $10 a pop. Okay, what is going to happen with these contracts? This put contract right now at 15 is worth $3 a pop. Okay, you buy this contract, you have the right to sell your stock to a buyer of this contract for $3. Sorry, to the person who sold it to you for $3. You can sell the stock to them for $15 a share, but you paid $3 for the right to do so. You have a put contract in your hand. The stock drops in value. This put contract is worth money because if you can sell stock to somebody at 15 when it's trading at 10, you're in the money. You're in the money $5 plus whatever time is left on this contract. And at the end of August, we still have September, October, November, December, and part of January. We have almost 5 months of time that this contract still has left to live going forward, which means the stock could go to 8 or 6. I mean, there's no limit to how low it can go to 0. But let's just say it goes to 10. It's now 5 in the money. It'll be worth at least $5 plus premium, time premium. Right now, it is out of the money because the stock's at $16.50. You can sell the stock in the market for $16.50. You're not going to sell to somebody for $15. So it's got $3 of time value. It'll probably still have $2 of time value even at the end of August because there's still 5 months of time left on this contract. So if it's got a $5 book value, the difference between 15 and 10 plus $2 in time value, the likelihood is that this contract will be worth about $7 a contract. Again, the market maker will quote this contract around the $7 mark. It might be $6.80 bid and a $7.20 ask. Right around the $7 value is what this will be trading at. This contract here, you can sell this the stock right now to the option seller for $17.50. You're already a buck in the money right now. This will still be in the money. It'll now be a $7.50 in the money. Well, this one was $5 in the money. This will be $7.50 in the money, and it'll have about a $2 premium. It'll be worth about $9.50 a contract. Let me write that down there. And this one is a $20 contract. It's going to be in the money $10 because you can sell your stock for $20 a share right now. You'll be able to sell it at 20 when it's trading at 10. It'll have a $10 book value plus $2 time value. $12 is what this will trade for. So if you buy this contract at $3 and the stock drops $6.50 to 10, right from here to here, this contract will go from $3 value to $7 in value. You will make $4 a contract times 100 shares, giving you a profit of $400 per contract. $400 a contract. This contract will go from $470 to $950 in value. Again, if the stock drops in price. So the players of this contract here, I think, are going to clear about $4.80 a piece. $4 is $8.70. Yeah, $4.80 in profit. And this contract player will times 100 shares, $480 in profits for each contract. This one here will go from $6.50 to $12. They will be up $5.50 or $5.50 a contract or share times 100 shares. That's $550 per contract. So you're going to make anywhere from $400 to $480 to $550 on these 3 contracts if the shares drop $6.50 a piece. So on puts, you can make money on the way down. On calls, you can make money on the way up. And the question is how up, how far up, how far down, and how soon can this happen? That is the catch. If this stock went to $10, but it took until January to do so, if it took until January 2022 to finally reach $10, and you're still holding on to this contract the whole time, you're holding on to all 3 of them, they won't be trading at $7, $9.50, and $12 a piece on the last week of the contract's lifetime. They will only trade for what they're actually worth in book value. So using this example here, the $15 contract will have a $5 book value, just like it has here, but it'll only trade at $5 at the end of its lifetime. You'll still make money because you paid $3 to get it right now. You can still sell it for $5. This contract here will be worth $750 in book value. It'll be worth $750. And this one here will be worth $1,000, and it'll trade for $1,000 a contract, $10 a share. So you're up $350 on this one. You're up about $280 on this one, and you're up $2 on this one. But if the contract, if the stock goes down sooner rather than later, you will get time premium on top of the book premium. And so instead of getting $5, you'll get $7. Instead of getting $750, you get $950. Instead of getting $1,000, you get $1,250 a contract. Time is still your friend if you have time. when you sell your contract. Time is the enemy, though. If you are hanging on to the contract to the very end because the stock hasn't done what you wanted it to do. You thought it was going to drop right away, and it didn't drop right away, and it took the longest time until you got your money. Any other questions?
So again, your risk is your initial investment.
What are you risking? Exactly. If you're going to buy this contract and you're wrong, the stock goes up like SoFi is going to go up. Of course, it's going to go up. This contract is you're risking all $3 a contract, $3 a share, $300. You can lose all $300. If the stock goes up, all these contracts will be worthless. If the shares go high enough, they go up to $20 a share. These puts are worthless. I mean, this one is at the money, but it'll be still worthless because it has no book value at all, only time value. And if this is the end of the January by 2022, these contracts will die out of the money. This is at the money, $2.50 out, $5 out. They'll have zero value whatsoever. And that's all you can risk. You can't risk $500 on a $300 purchase. You can't risk $1,000 on this. You can't risk $800 on this. You can only risk what you put into the contract when you buy a contract. This is why puts are so popular with a lot of smaller investors, because they know that I don't have unlimited losses if I'm wrong. If I short SoFi, if I go short this stock and it goes up, I have unlimited losses. But if I buy a put and the stock goes up, I can only lose my $300. I don't lose more than $300. So I don't have to do anything but buying stock or selling somebody's stock or getting anyone's stock. I don't do anything on the exercise on this contract. I bought it for $3 and I was looking to sell it for more money. That's all I was trying to do. If the shares only go down to $14.50, instead of going to 10, they only go to $14.50, but they do it immediately, these will go up in price. Maybe not to $7, but they might go up to $4 to $5 a piece. These might go from $4.70 to $6.50. These might go from $6.50 to $8 odd. There's a profit to be made here if the stock does drop. And in the last week or two, we have noticed time and time again that our friends at SoFi, the shares of SoFi, have dropped in price again and again and again. And so put contract players have been making some money because the stock went from 18 to 17 to 16.50, or from a month or two ago from 22, 23 down to here. Of course, we also know that the other day we noticed about a week or so ago when Gore's Holdings shares went up $2.50 in like 45 minutes, when we found out that Matterport had signed an agreement with Facebook to share Matterport imagery. That caused the stock to run up from what was it, 14 to 16 something dollars. It went up to something very quickly. All the options on the calls went up. All the put contracts went down instantly to mirror this move. And the market makers in Chicago were very busy for a few hours that day as they were marking up and marking down the call and the put contracts as they were doing this, as Gore's went sky high there for a while. Now, I think Scores got over $17 a share and then it backed off again, but it had quite the run. And that's just a hint of what might be coming for us on some of these SPACs that we're following here as they make deals and make announcements and turn over their company. Obviously, on Gore's Holdings, we know July the 20th is a shareholder vote to have Matterport formally take over Gore's Holdings and become Matterport. Between now and then, the shares might rise up again, and that would make all contracts go up for calls and all puts go down. But then after the deal is done, we don't know what happens in the first week or two or three of trading. It could be that Matterport jumps up and down $5 a share for like 2 or 3 weeks, up and down and up and down. And there could be a lot of momentum players in the options market playing Matterport shares as they find themselves, kind of thing, obviously.
Does it mean to exercise?
What does it mean?
To an option. And could you explain the buy to open, sell to close, the open and close idea?
If you're playing the options market, you have to tell the options exchange what your intentions are when you enter a trade. So if you're just you're somebody who feels that your shares of SoFi are going to go higher, your thought is, I'm going to buy a call option because I think the shares are going higher, and I would like to buy a call option at say $2 and sell it at $6. I want to make $400. The options exchange is asking you, are you buying these calls as a first transaction? Is this the first move you're making, or are you buying these calls because you sold calls before, you shorted them, you wrote calls, and you're now trying to buy them back? They need to know what transaction is going on, and I'm going to show you something on the board here that will help explain all of this. Bear with me while I wipe this all out of here. Some of you have noticed that when you're looking to figure out how much an option is going for, you'll look at the bid and the ask, and you'll see all these numbers, and you wonder, what do these all mean? So let me show you what I'm talking about here. I'm holding up here my big ass iPad, and I'm on the Market Watch website page right here, and this is SoFi call options being quoted here, and I'm going to show you what you're going to see. I'm going to show you what you're going to see if you are looking for a quote on options, and these are the January 2022 call options. Right? Forgive me about the glare. We'll get this. We'll make this go away in a minute. Okay, let's take a look right here. We have typically what you'll see first is something called the strike price, and I want to use red for this. Strike price. So we're going to hear strike, and this will be the exercise price of a contract. So on the case of SoFi, I'm going to just use the $15 contract. Okay, every contract has its own value, but I'm going to use the $15 contract. $15 strike, which means that if you buy this contract, you have the right to exercise your stock at $15. You can buy the stock from somebody for $15 a share if you own this contract. That's what this means. The second column, let me get a moment here. Last. The next column is change. CHG. Yeah. CHG. Bid ask, and then I've got volume and open INT. Okay. All right. Hang on, folks. Here we go. All right. The strike price is $15. Last trade, $4.73. The change on this contract was negative 0.07 cents, so negative 0.07. The bid on the 15, 460, 470. So we have 460, 470. We had volume of 879 and 879, and OI was 13,050. 13,050. Okay, guys. What are we looking at here? All right. This is just one contract out of all the contracts that trade on SoFi. Okay. January 2022's the exercise price or the strike price is $15. It's a $15 contract. And in the case of the January 22 $15 contract, the last trade that was registered on the Chicago Exchange was $4.73 a contract. They don't trade in exact nickels or dimes. They can trade down to the penny. So this contract last traded at $4.73 or $473 for a one call contract. The change on the day from the day before was 7 cents. So it went down negative 7 cents on the day. The bid, the highest price someone's prepared to pay at the end of the day was $4.60. The cheapest seller was showing at $4.70, which this could be a market maker on both sides, or these could be legitimately individual investors making their best case. The last trade, though, was at $4.73, higher than the offer. So it traded a while before the close of the day. This is not at the close, that last second of the day. This thing traded at $4.73 sometime in the afternoon, but at the end of the night, Friday night, this contract was $4.60, $4.70, likely because the stock had been coming down late in the day, which we were watching, and the bid asks shifted, but no trades were recorded. The volume for the day, 879 contracts traded hands on the day. What we don't have here is what the highest price paid on the day and the lowest price paid for the day on these contracts. We only know that 879 actual contracts traded hands. Now you think about how much money we're talking about. This is last trade 473. You multiply $473 times 879 contracts. That's how many dollars traded hands on this one contract on Friday. The last number here is called open interest, OINT. What does that mean? It shows all of us how many contracts exist. There are 13,050 actual contracts that are in existence with a $15 strike price that last traded at 473 and are valued at 460, 470. 13,050 contracts exist. So when you come in to buy a call option, you think the stock is going to go up in price, you want to buy this contract, the $15 strike, you're going to have to pay anywhere between 460 and 470 to get it if you had been coming into this market at the end of the day. And if you were coming in to buy one of these at, say, 465, the market would have gone 465 to 470. But if you were a buyer at 460, that's your bid right there, 460. There might be 5 others trying to buy with you, but there's your bid. When you put in an order to buy a contract as your first transaction, because you want to acquire it, you have to indicate to the Chicago Exchange that you are buying to open. It is an it's an opening position for you. You are buying a contract to open a position to go long one contract, 10 contracts, 100 contracts, however many it is. If you were a seller, though, at the end of the day, you had bought these a week ago for $3 and you were trying to sell out and you want to make a profit on this thing, you might have been the seller at 470. If you already have the contracts, you're trying to sell them, you're now selling to close. So you're either buying to open to start a transaction or you're selling to close to get out of a transaction. The Chicago Board of Exchange wants to know this because if you are if you're selling to close, for example, and you do sell 10 contracts, you get out of 10, this number will now go to 13,040 because you sold 10 of your contracts that you had. You don't have them anymore. This goes down. If you're a writer of contract, you own SoFi shares, and you're looking to sell this contract into the market because you're betting that the shares won't go much above $15 or not very far above $15. They might even go down a little bit. You might be interested in selling this contract. So you're going to offer it for sale. Well, you are now selling to open because you don't have contracts. You have stock. You don't have a contract. But you want to sell a contract to buy it back later if the stock goes down in the next week or two or a month or two or whatever. So if you're selling it at 460 and you get out, you sell 10 of them, this number here will go from 13,050 to 13,060. You just created 10 additional contracts. You're selling to open. But when you buy your contracts back, let's say this does go down and you buy them back at 350, 250, 150, whatever price you buy back at, you're now buying to close. You are closing out your position. You're buying to close your position because you had open to sell, sell to open. You're now buying to close. And this goes back to 1350 from 1360. Yes?
So they're wanting to know how interested should they be in the volume and in the open interest.
I mentioned earlier that an option contract that trades, that has a strike price very near the price of the stock is usually a very active contract. The stock closed at $16.48 on Friday night. It's only $1.48 away from this strike price. It's very close to the money. This contract with 13,000 open interest is showing me that there's a lot of contracts in existence, and 879 is a lot of volume. This does represent, by the way, 879,000 shares, because you put 2 zeros on the back of this, because each contract is 100 shares of activity. We're talking about 87,900 shares that traded just on this contract. Taking a look at at my Market Watch thingy here, the 15s had 13,500 open interest. The 1250s that are way out of they're in the money, they only have 2,800 options in existence. The 1750s they're ahead of the market. They're a dollar above the strike price, the actual current price of the stock. The 1750s have 9,600 open interest. But interestingly, the $20 contracts, which a lot of you were buying when the shares were at 2022, 21, 22, and so on. When I started mentioning SoFi to all of you, and the stock was $14, $15 a share, and then they went to 16, and they went to 17, and went all the way up. A lot of you bought $20 call options because it's a nice round number, $20. There are 23,387, actually 23,800 open interest in that contract, and they did trade 2,300 shares on Friday. So they traded more contracts at 20 than at 15, much more active. There's many more in existence. The 2250s are 8,800 of them, and the $25 contracts are 11,400 of those. So each strike price has its own unique number of open interest that exist and how many actually trade during the day. The further a market moves higher or lower, these contracts will vary in how many contracts will trade per day. Because if you are right at the money, that's where the action is. People are buying and selling right now with as little premium as possible. They're trying to buy right at the money calls or puts, and they don't want to pay book value. They're trying to get in that much. So those will have more volume and more activity. On Friday, it is true, though, that the 20s were the number one traders. They traded 2,300 contracts. The 1750s traded 1,100. The 15s traded 879s. And the 15s are nearer the money than the 20s. And yet the 20s out-traded the 15s. That's only because there's almost double the number of contracts in existence. Yes?
So earlier,
Way back.
way back, you were talking about how options give you the ability to take advantage of market fluctuations. So here we have a comment by Jason says, for GHVI, when it spiked last week, he sold all his contracts knowing that the news was the catalyst for the rise, and he then bought them back this past week.
Yes.
So you could talk about how it's one thing to buy a stock and put it in your portfolio and get married to it and never leave it and everybody's happy. But options allow you to take advantage of market fluctuations.
That's true.
And maybe on a daily, hourly basis.
Yes, that's also true. This contract right here, this $15 contract right here, with SoFi, the shares of SoFi on Friday, I believe, were around something around the $16.75 level, and they reached, I think, $17.50 or something like that. They ranged 75 cents. And it's possible, it could be possible that of all this volume here, 879, there could have been people selling these contracts when the stock hit the $17+ level during the day. This happened in the first 2 hours of the morning. And these contracts could have been as high as $5.25 at one point when the stock was at $17.50. And they may have bought the contracts, like a month or so ago when the shares were $14, and they could have paid $3 for these contracts, sold them for $5.25. At the end of the day, they could be buying them back in this $4.70 level as the shares came back to $16.75 right here. The viewer here is correct. They may have he sold his contracts in Gore's. When Gore Holding had that $2 gain in one day, the whole market went up and all the contracts went up with it. And he sold his contracts at a nice price, sat back, folded his arms, watched the stock over the next 3-4 days, slowly slump back. And now he's picked off his contracts and he bought them back maybe $1.50 a contract less or $2 less. And now looking for another pop again from here. There are option players who are momentum investors. They like to buy they like to follow certain stocks. They are comfortable with how certain shares fluctuate in price. They can sense resistance at a certain level of the stock going up. They can sense resistance, and they can also sense support when the stock reaches a lower price. So they have a range between maybe $12 and $15 a share, or $110 to $120 a share, maybe 160 to 180 a share. GameStop, there are people out there who are momentum traders on options on GameStop, where they'll see us the GameStop shares go from 190 to 170 up to 210. They'll see this and they'll play this. They'll go long on calls, or they'll go long on puts based on the way the market is fluctuating. Some folks are day traders in options, because you have to figure out that if you can buy 10 contracts for $2 and sell 10 contracts for $2.20, it's only a 20-cent move, but that's $200 in profits, because one contract goes from $200 to $220. 10 contracts is $2,000 to $2,200. And there are day traders out there who are looking for a couple $100 returns on contracts and or on shares, or on both. And so there are players who will buy, like they'll look for 50-cent contracts, 80-cent contracts, $100 contracts, $1 contracts, $1.50 contracts, $2 contracts, trying to flip 10 or 20 or 50 or 100 at a time. Certain stocks have much more volume on their options than others. For example, if you're playing, say, Apple contracts versus SoFi contracts, you might find that there are 879 share contracts trading on SoFi, but and on some of these are as high as 2,000 shares in one day. In the case of Apple, at the money Apple contracts that expire in 3 weeks, 4 weeks, they might trade 20,000 a day, 30,000 a day. Very serious volume. Incredible liquidity. The difference between bid and ask might be 5 pennies, 3 pennies, 2 pennies. It might be 160 to 162, or 460 to 462, or 468 to 470. Last trade right in the middle of the bid ask all the time. Always buy 100. You can always sell 100 at every penny on Apple all the time. Market makers keep good liquidity on those contracts, knowing the volume of those kinds of contracts. Some of these contracts will trade hundreds of thousands of contracts a day, and you will get professional traders that'll buy 100 call options, and all they're trying to do is make a dime on it. So they'll buy 100 call options for $2 and sell them for $2.10 times 100 contracts. So it's $10 times 100, it's $1,000 flip. And they'll do that 20 times a day, hoping to score every time. Sometimes, though, they're wrong and the stocks go the opposite direction. And what they'll then have is they'll buy a call for $2 and put a sell in there for $1.90 if they're wrong. And so they're in at 2, looking to sell at 210. And if it goes to 203, 204, and then backs off to 190, they get blown out. They're out. They've lost $1,000. They sit back now and watch the stock. It backs off, and then the contracts go down to 185. And now it looks like the stock is solidifying again. They buy in at 185 for 100, put a sell order in 175, and are looking to make a $10 move on the upside. The stock goes a little higher. They're right. The contracts go to 195. They get out, and they've locked in $1,000 gain. Now they had $1,000 loss. $1,000 gain. They're even on the day. Now they're watching the market to see again where resistance and support is, which again, the stock constantly trades up and down. Stocks have like a pulse from time to time. Option traders try to maneuver themselves in the middle of the momentum of the day, of the week, of the month. And there are some who trade by the minute, some trade by the hour, some trade multiple times a day, others trading a couple of times a week. Some only trade once in a very blue moon. They take long positions and wait. Others are really short-term gamblers. They're looking to get in, to get out, to get in, to get out. And this happens through all the options that exist, including index options. You can play the index of the NASDAQ 100, which are the triple Qs. You can buy options on triple Qs. You can play S&P 500 contracts, options contracts on the S&P 500 index, trying to guess the momentum of the market. And you are amplifying your bet by buying these contracts because you're multiplying your results. Very risky, very complicated, very sophisticated. I bring it back down to what are we following and what are we doing with the marketplace. I talked to you about the stocks that I like. I mentioned to you my favorites. Here they are right here, for example. Hold on. We've got them right here. Here we go. Apple, Cisco, Facebook, GameStop, Home Depot, IBM, Intel, Microsoft, Micron, and SMH. The SMH is the ETF. That's this ETF right over here. You can buy options on the ETFs. They're trading at about 250 something a piece. You can buy and sell call options or put options on the SMH. So if you believe there's a computer chip shortage, like I do, this ETF has 60 different stocks that make up the ETF. Well, you don't have to buy call options on all 60 of the stocks. You can buy call options on the ETF because those units have options against them in Chicago. And so if the ETF is trading at $255 a unit, and you believe that in the next, say, 2 or 3 or 4 months, they can reach 260, 265, 270, you can buy call options on the SMH call options out to, say, next January or February or March at 260, 261, 262. So you name the strike price, you'll find that the options values vary. Again, how far out of the money they are, how long they have to live, and you can play the leverage of hundreds of units of the ETF by just buying call options, 1, 2, 5, 15, whatever number you want. And so there are people out there who will buy 100 call options on the SMH. Watching the market have a bad day on Wednesday, like we saw with the Dow going down and having a lousy pre-market, they're buying call options when those the SMH units were at 248, hoping they're going to go back to 255, and they're buying 250s for 6 months out. And the SMH the next day or yesterday had a good day, they might sell out for $1 or $2 higher on their contracts because that unit went up in price $3 or $4 or $5 a unit. This is what's going on all the time. Any other questions that I needed?
Old-time stockbroker, that when we had a person come in that might be a new client, we would do a due diligence with them and figure out what their risk levels are.
Yes.
That people are asking, how do I know when to open? How do I know when to close? How do I know if it's high enough? That people, because they don't have that broker anymore, they're doing a lot of this online because
Correct.
the commissions are so good.
They
They have to do their own due diligence. You have to be aware of your risk tolerance. And that's how you know when to buy and when to open and when to close. Go.
Back in 1978, 79, 80, when I was beginning as a broker, we had to have a special license just to buy and sell options contracts. We had to pass a securities course, an options course, just to be able to do options trading. We had to understand the ins and outs and the risks involved with options trading. And then we had to inform our clients, and we had to get them to sign forms that said, I understand and accept the fact and will not hold you liable that I could lose all my money buying and selling call options.
And that's what the online platforms are doing when you agree to their terms.
When you are buying and selling options with this, you had to agree to the terms and conditions. Did you read them? 50,000 pages of legal gunk. It's all in there, and it takes the broker off the hook that if you lose all your money, it's not the broker's fault. It's your problem. The broker isn't responsible. But you have to predetermine what it is you're looking for when it comes to what kind of a contract or what kind of a profit you're going to want to make or what kind of risk you want to take on whatever it is you're going to do. So, for example, if you're going to buy this contract right up here, the $15 SoFi call, and you're going to pay $460 to $470, the question is, well, what would be a good price to take on this contract? Well, look at the price of the stock. It's $16.48. That's where it closed on Friday night. If you believe, like I believe, that in the next few months, as more people find out about SoFi and understand what this company is about, and you watch the volume of the stock continue to increase that we've noticed in the last few weeks, I think this trend will overall continue unabated. It will continue going forward. It will continue becoming a meme stock talked about on Wall Street Bets and other places. And so I think the shares can reach this $25 level, if not $30. This call right here at $4.60 a share, $4.70 a share, this price right here is screaming opportunity to me, because I'm looking at it going, well, it's a contract that lasts until June 2022. It's got a long time to live. If the shares in the next 2 or 3 months reach this $20, $25 neighborhood, These call contracts will be worth a lot of money, obviously, because with a $15 strike price right here, the stock reaches $25 a share. This is $10 in the money. It still has 3 months of life left in it. It's going to be a $2 time premium on top of the $10 book value. These will be trading at $12 a piece. Last trade on this contract, $4.73. So, I mean, if it's worth $12 and I can buy it for $4.73, I spend $473 to turn it into $1,200. That might be the number I decide to sell it at, no matter what the stock does. If the shares go up Tuesday and Wednesday this week to 1850 to 1950, this contract will probably run up to the 650 level. But if I decide that I'm going to take an 1150 price to sell, then I'm just going to stick to my guns and say the minute it's 1150, I'm out of here. I don't care what the stock is trading at and how high it's going to go from here. I'm out at 1150 because this contract has until January the 22nd to live and no longer than that. And at $11+ a unit, if I end up scoring a $750 gain on every one of these, and I've got 10 of these guys, I've scored a $7,500 profit on my investment. I'm happy to take this kind of money. Bruce on his channel might be yelling at all of us to say, hey, these contracts, the stock has gone to $22, $23, $24 a share. You should all be doing really well right now. You might want to consider selling these calls at whatever they're trading at the time, which might be 8, 10, 11, $12 a share. Sell them. Take about a quarter of that money that you get from these contracts and buy new contracts for 2022, but not January's, but maybe July's or August's. You're going to buy new contracts at perhaps the $25 mark or $27.50 exercise price, because that's where the stock is now. It's gone up for next year's summertime. Another 9 months of life, perhaps 8, 9 months of life. 3/4 of the cash that you're taking from selling these contracts at a lovely profit, you might turn around and buy other contracts with that money. Contracts in new SPACs that we've uncovered or existing SPACs that haven't made the move yet. You might be averaging down. Maybe you bought some calls at $6 and now you're buying some more at $4 and you're buying some more at $3 because you still believe in the stock. You still believe in the upside of the deal. You feel that these contracts can go from $3 back to $6, but you're going to average it down to $4. When they get to $6, you sell out of everything and you've made your money. You can do whatever you want with your profits, obviously, into whatever else you want to get into. That's the beauty of the options market. Again, you can only risk what you pay for them. You can't lose any more than what you pay for them. You can make unlimited money because if this stock goes to $100 a share, Amazon comes knocking and says, we're going to buy you out at $100 a share. These $15 contracts will be $85 in the money. That's $8,500 a contract. You paid $470 to buy this contract. It's now worth $8,500. You're one happy camper. You got 10 of them. You got $85,000 for your $4,700. Yeah, you got yourself some nice coin. Yes, ma'am.
I don't want to say a convert, but we have someone who had the epiphany. So a call option allows me to gain profit from the stock without having to spend the money to purchase the actual stock.
Yes.
Leverage.
Yes, yes, yes. Again and again, yes, yes, yes. This contract right here that's trading at $473 is giving the buyer of this contract, you buy this thing at $470 or $470 on the end of the day here, you pay this price for it, you can benefit on the gain of the value of this stock because you have a $15 strike price. This stock is $16.48. It goes to $25 a share between now and January. Now and January, it goes to $25 one time, just for 1 day, 1 hour, for 5 minutes. It reaches $25 a share. This contract will likely be trading at $12. You can get it for $470 and it's worth $12. You just sell it for $12. You don't exercise any stock. You don't buy any stock. You're not on a hook to buy any stock. You're just going to sell the contract because you bought the contract in the open options market. You're going to sell it in the open options market and you're going to take the difference for your pocketbook. So yeah, you buy it $470 and sell at $12.70. You made $8 a contract, $800 a contract net profit in your pocket. You've got $4,700 that you want to gamble on SoFi on. Yeah, you can buy stock for $16 for $4,700. You can buy about almost 300 shares. Or you could control 1,000 shares by buying 10 call options at $470 a piece. $4,700 gets you 10 of these. That controls 1,000 shares. This goes to $25 a share. Yes, your $4,700 or $4,800 buy to buy 300 of these, you'll make about $850 a share. Yep, you've made about $2,500. But this goes to $25 a share. These will be worth probably $12 a shot. You got 10 of them. You got $12,000 from $4,700. You made more money than the shareholder has, of course, because instead of controlling 300 shares, you're controlling 1,000 shares, and that is the leverage factor coming to roost. Yes.
So why do people buy stocks instead of options?
There's the difference, right? Look at the amount of money that this person has to pay. You buy this contract for $470. Compare that to the price of the stock at $16.48. Okay, you're paying about a third of the price, aren't you? 3 times this is not quite this, but kind of in the neighborhood. It's around 30%. In theory, a lot of you out there, the gamblers out there, and I'm not saying you are, but there are some serious gamblers out there. You probably know some or have heard of some. You can buy this stock on margin depending on the brokerage firm you're dealing with. And in some cases, you can buy this stock for 50% margin. In other words, you only have to put up half this money to buy the stock. You can buy this stock for $8.24 of your money, and the broker will lend you the other $8.24 to buy this stock. Now, all of a sudden, you're looking at it going, well, wait a minute, for $824, I can control 100 shares versus coming up with $470 over here. Hey, there's no time limit on this. This thing's got a time limit on it. It dies in January 2022. This never dies. This is the stock. Maybe I'll just put up half the money. And so some people go, I don't want to pay $470 for a contract. That's too much money. I want to buy a contract for maybe $3 or $2.50. What contract can I get for a cheaper price to leverage up this stock? How can I do it? Well, you're going to have to buy a higher priced strike price. You're going to have to buy $17.50 or a $20 or a $22.50. The higher, though, that this is, the more expensive this is the more the stock has to move for you to make any money. You're out of the money. You're not going to make as much if it goes to $25 a share. You buy a $20 call, it's $5 in the money, not 10 in the money. Sorry. It's not 10 in the money like this one is, obviously.
The attack of the board.
The attack of the board. So you have to weigh one against the other, obviously. Yeah.
Can I put, I don't know about IRAs, but I don't think I can put an option in my RRSP or my TFSA.
Yes, you can. In Canada, you can buy options inside RRSPs now and TFSAs. In the U.S., you might be able to buy call contracts inside of IRAs. And in 409, 401ks. It all depends on how they're structured. That's something you have to check with your local tax advisor on to double check, and with the broker that you use to whether or not you can do any of this through those retirement plans. You may or may not be able to do it. Let me just double check at a couple of my notes here that I want to double check on. Why investors buy options? Because you can control 100 shares for a lot less money. Buy 100 shares for $1,600 or control 100 shares for $4.70.
Leverage.
You've got leverage. Buy to open, sell to close is how this works. Time premium, that's what these have right here. This contract, a $15 strike price, is $1.48 in the money right now, but the rest of the value of this contract right here is time. And you take $1.48 away from $4.70, you are paying about $3.20 in time between now and January to hold this contract at the moment, to buy it now. In 3 months from now, this contract, the stock stays at 16.48, and 3 months from now, this contract will not be worth $4.70, but probably be trading at $3.70 or $3.50 because time will shrink, and that means the value of this contract will shrink its time value. The book value is always there, but the time value will shrink to nothing at the end. Open interest, we talked about that. In the money and out of the money. This contract is in the money. It's a $15 strike price with a share price of $16.48. It's in the money right now. If the stock drops to $15 on Monday morning, this contract will be at the money. If the stock goes down to $14 on Monday morning or Tuesday morning or whatever, this contract is out of the money because it's a $15 strike price with a $14 market value. This stock goes to $17.50 from $16.48. It's now $2.50 in the money. The difference between $15 and the market price. All right. Exercising options, never. You never need to do that. Options expire every Friday, and they get created every Friday for the new series going out, way out. You can always create new options any day, and options can disappear every day. This open interest number can fluctuate every day because sometimes writers buy their calls back at whatever price they want to buy them back at. Bid and asks, there's always a bid and an ask on every contract. There's always a buyer. There's always a seller. Sometimes the spreads are 50 cents. Sometimes they're $1. Sometimes they're 30 cents. Sometimes they're a dime. Sometimes they're down to a penny. And market makers make markets on options all the time, 5 days a week during market hours. That's their obligation as their contract with the CME. They must make a market for the contract and offer liquidity on both sides of the market at all times. That is how options work. I hope you enjoyed this and found this helpful. If you haven't and you still have questions that you can't quite figure out, you can send me a private email at brucefarmer@hotmail.com or go to the website, stockmarketswithbruce.ca. Go to our website and you can send me a message there. It'll come right to my email, and I'd be more than happy to try to answer your question for you. And those of you who have questions as well from watching the edited version, send me an email. If you have any questions, you can use the website through contact me, or you can send me a personal email at brucefarmer at hotmail.com. More than happy to try to help you out. Watch me Monday to Friday, for 5 hours a day on the Stock Markets with Bruce channel. Uncle Bruce is on 5 days a week, Monday to Friday. And you can ask me questions there as well about options, whether you're going long, going short, or whatever else. You're just going. I mean, if you're going, you're going. Thank you all so much. Those of you who are not here tomorrow, I'll see you on Monday morning at 8:30 Eastern time, as usual, as we follow the markets right off the get-go, see what this market wants to do in the pre-market and then open up, and then in the afternoon on Monday as well. And those of you who are TWB followers, Monday, the Hangout Show at 7 o'clock and the Big Show at 8 o'clock, Traveling with Bruce, for those of you who love to follow cruise ships and interest there. In the meantime, have a wonderful day today. Stay healthy for me. Those of you returning tomorrow, we'll see you tomorrow at noon Eastern time. We'll do it all again. And I thank you all for being here today. I wish you all the best. Stay healthy, and we'll catch you later. Bye for now from wonderful Creston, British Columbia, here from the living room of our home. And we'll see you tomorrow.
Bye.
All right? Bye. Okay. See you guys. Take care.